Mr. Chris Slightham, thank you for joining me again. It's always a pleasure to have you either online or doing presentations in person for our clients. For those of you who don't know who Chris Slightham is, he is the CEO of Royal LePage Signature, which is the largest, most successful. I don't know if it's the largest, but anyway, by deal volume, it is the most successful Royal LePage brokerage in the country. I'm relatively new here. I joined here about 2 years ago, and the reason why I came over was I saw the incredible value that Royal LePage Signature offered to brokers. And that value is value that we're able to pass on to our clients over and over and over again, whether that's through marketing support, admin support, coaching, training. But particularly, I really like the market data and the way you're able to really break down micro data, macro data, and really present it in a way that tells a real story of what's happening in the housing market and the economy. And I don't think there's a better time to really be able to look at this data and understand it when there's just negative headline after negative headline. And that's amplified these days by social media, self-proclaimed experts who are really only focusing on the negative, because that's what gets clicks and gets people emotionally committed to their content. So this is not one of these. Where Chris is going to bring it to you, the real data, and it's not going to be maybe the best of news today, but I think we're all excited about the story the market's telling us right now and for the future of the market and the direction it's going to be going. So Chris, thank you again for being here. Without further ado, please jump in and really show us what's happening in the market today. And just one last thing, when Chris is presenting, I'm always learning. So for those of you watching, it is really important to ideally stick around and you'll learn a lot. And at the end of this, there's a report that we'd love to share with you guys. So please reach out to me directly and we'll be able to share this report with you.
Fantastic, Ryan. Thanks for having me today. I know how we align with our view on data and the value of better understanding information so that you can make better decisions, right? And I think that's how you've run your business and how you've advised clients for years and been so successful in doing that. And that's why we do this, right? And to your point, headlines are eye-grabbing, and this particular headline on the start of our report certainly grabs people's attention. Prices fall 22% in 4 years to under $1 million. It's for the GTA. It's like, oh, geez, wow, that's a major correction. But unless you know the background around it, it's hard to really put that into context. So hopefully we'll do that for a few minutes today. And as you said, you're going to provide this full report to anybody who reaches out to you from the podcast, and any of your clients get it anyway. And so you're going to, your people can take their time after and kind of dig into the weeds if they so choose. And that's what we want to do. We just want to educate people, right? So they make better decisions. So anyway, we'll get going here on this. I'll cover a few. I'm just going to cover a few points throughout the report, and then we can, you and I can obviously banter back and forth and debate a few things maybe, or discuss a few points, and then we'll take it from there. But this is really an interesting time in the market as we're here in February of 2026, and we're celebrating, as I say, the 4th anniversary of the peak of the market. I don't know if that's a celebration or not for some people, but it's certainly acknowledging it's been 4 years since February of 2022 when prices peaked, right? And that's, we know why now. We know that the Bank of Canada had interest rates too low for too long, and if we can remember that far back, I can't believe it's 4 years already. Inflation went to 8% in 2022. It was out of control. We haven't had 8% inflation since I don't know when. And so, we every part of the economy was hot, and real estate, because it's so interest rate driven, it was really hot. And we can show you here in a minute or two on a couple of charts where it had come from, why it did behave the way it did, and what it looks like today. And so, we're paying the price, so to speak, right? We had we had artificially low interest rates for almost the better part of 2 years, and then and people took advantage of it because during COVID, the Bank of Canada and world banks globally made a decision that hey, we got to keep this economy bubbling along. When people had to stay home, they had to figure all that out. And how did that work? Supply chains got disrupted. It was crazy what was going on. But what happened here in Canada, and the GTA in particular, is with all the programs that the federal government brought in, combined with low interest rates, it kept people employed. Our banking system is very solid, and credit was available. And so, people had money to spend. They had money to spend, and interest rates were basically free. They're actually technically negative relative to inflation. So you were getting free money, and people jumped on the bandwagon and made a whole bunch of buying decisions, and that propped up the market. And we, of course, have to reset, because when things go crazy, you have to reset and get back to the averages. So, just a quick summary from last year, because, we can see that, we had a tough 2025. Coming into 26, we'd hoped for a little bit of better volume, but hey, if you're living in the GTA, you'll know that January 2026 was the worst January weather-wise that we have had in, I don't know, decades, right? And so with that, we have a situation where, we're stuck here in the snow and we don't have anybody to buy and sell real estate. So we saw a significant drop in transaction volume. And with that, of course, comes that headline grabbing prices drop below $1 million.
I can tell you that across our listings, we have a number of listings, but we had 14 showings. I think the number was booked in January, and only 4 ended up going. They were canceled. People were hibernating. They didn't want to leave. And another important thing is that, people didn't really go back to work, I think, until January 6th, or schools were back, work was back January 5th or 6th. So, that's a good chunk of the market as well. People aren't out there looking while they're still away on holidays, right?
100%. And so, it's a slow start to the year. There's always a rate announcement in January. A lot of people wait to see maybe what the Bank of Canada is going to do with rates. They ended up holding rates, of course. So that's where we ended up, having a, low transaction volume. And of course, the biggest snowstorms, and I think, in modern history for January records. So none of those things were positive for real estate. And so I don't take a lot of, concern in the numbers, because we also know that a lot of the transactions are first time buyer transactions, which actually sways the average sale price down a little bit during that time period. And so there's a number of factors that are driving. Look, real estate is not strong right now. I'm not trying to candy coat it in any way, but there are real factors that I think are important for people to know and understand when they're making decisions, instead of just reading headlines and saying, hey, the market's in the tank. So, we saw the prices drop, but it's a little deceiving because, as we get into the data here, you'll see that the average sale price for detached homes in central Toronto is still over $2.3 million. So it's a little, confusing when they're throwing out these headlines, and that's why it's important to dig in to the data and see here, what's going on. And so they take the report that we get produced every month here from Urbanation is absolutely brilliant. The team there are super smart. They've been doing this for decades, so they've got tons of history. They know what it takes. They know historically how markets behave, and they know how to present the data in an effective way where we can all understand it. And, I want to just point out to folks here back in, the 2021, it's almost like it's given us the finger. Is that okay to say on your podcast?
Oh, yeah, absolutely.
And it was a pretty wild year, right? We had a ultra low interest rates. COVID, we had, if anybody dares to remember, and I don't know if you want to call it a vaccine now or whatever they call it, but they had a solution supposedly for COVID by the end of 2020. So coming into 2021, we were able to get out. People were realizing there was light at the end of the tunnel, but interest rates were kept incredibly low at that time. And of course, people started making decisions. And look what happened in January of 2021. I mean, look at this. Look at this. I mean, the 10-year average is 4,600 sales, and there was almost double, right? Just in that 1 month of that year. So you can see what the behavior was. And of course, what happened is certainly supply got tight. I'll move down here. supply, even though this is new listings, but actual active listings, look what happened to the supply, right? I mean, it absolutely got decimated. And then in 2022, it was even worse, right? By 12 months later, we had the lowest supply in the history of the months of January in the Toronto Regional Real Estate Board. Like, you have to think about this, right? It's like, this is a market of 6-7 million people, and there's only 3,200 listings of any shape, size, type, price range, the whole 9 yards. Like, it's wild. And of course, what happens is when we track the months of supply, that we see these moments when you get down to this is a seller's market, right? This is a seller's market. But of course, just have to adjust my presentation here. You see today where we have almost 6 months of standing inventory. So when you've got,
and that's across all housing types.
That's everything, right? That's condos, that's detached, that's semis, that's rows, that's towns, that's all through the whole Toronto Regional Real Estate Board in their availability in the market. And of course, you see the difference from 21 and 22 to today. Well, you know what happens to price, because these are as exactly what they talk about here, price indicators. You see what happens next, right? Here we have prices are down, prices are dropping because there's availability. There's a ton of supply out there in the marketplace, and this is what's making the difference. And so, this is what's important for people, I think, to see. You can see this is, exactly 4 years ago, the peak pricing here, February, actually, because this is the January data, year over year, or each January since 2017 on this chart here on the left. And you can see the peak. And crazy to think that the average sale price in the next month, 30 days later, was $80,000 more at $1.333 million. Like, just over $80,000 in a month, prices went up. I mean, it was absolutely the most bizarre time that I have ever seen in real estate. And now, of course, we're paying for it.
Can we take it? Do you mind going back up to the chart above?
Sure.
So, I've been doing this for 20 years. You've been doing this a lot longer than me, and you're second generation. The brokerage is 50 years old. So you have a tremendous amount of knowledge. Your father have seen, a lot of markets. And, when we look at this, we're looking at the last 9 years or so of data. It's quite interesting. I was looking back at the 2008, 2009 months of inventory prices to kind of see, what happened there, how quickly did it turn. And it was interesting that in January of 2009, inventory was over 8 months of supply.
Mm-hmm.
And by January 2010, it was down to 2.4 months of supply.
Isn't that
now,
wild?
This is a different cycle, and there's different variables and stuff like that. But a really important thing to point out with months of inventory, that is 5.8 months of inventory based on today's sales, which are, close to record. I'm still probably at record lows.
Correct.
So even if it goes back to the 10-year average, that 5.8 months of inventory could actually drop significantly quickly if consumer confidence comes back to the market. Tell me about different kind of, there's been a few dips in the 20 years that I've been doing that. The significant ones have been the 2008, 2009, 2016, 2017, which, we're all different, but similar in the sense that there was, an interest rate or some sort of policy lever that drove them. Do you want to just talk about that a little bit as well?
Absolutely. And you brought up 2008, and this is the thing, right, is we got to remember that, that was the global financial crisis. So you think about what was going on around the world at that moment in time, and you see that the markets behaved appropriately, right? There was a pause because what happened is the whole economic system globally actually froze in late 2008. It froze because there was massive bank failures, the biggest failures in the history of the banking system, modern history of the banking system. We had, Bear Stearns, Lehman Brothers, these big, huge, 100-year-old massive financial institutions literally went bankrupt. And so that drove a freeze in the marketplace. Everybody hit the pause, but, I better not do anything right now. Is my job okay? What's going to happen if you go back and, look at the YouTube, probably search the news items of those days back then, and the sky was falling. I can remember watching, CNBC and the trading floors and what was going on back then, and thinking like, how are we going to ever get out of this? There's no liquidity, there's no money flow. And of course, the federal global banks got together and came up with a strategy. And that's when they first really started to use what they called quantitative easing at the time, which they bought a whole bunch of bonds. They just went out there and put money into the financial system very quickly. And by the spring of 2009 in Canada, we started to recover. The US, though, was so bad. Their system was so distraught with failures that it took until the middle teens, 2015, for their market to fully turn around. And we turned around in 6-8 months because of the difference of our banking systems. So, when you look at these moments in time, Ryan, as you said, there's different things, different reasons, all the sorts of factors that actually affect the valuation of money, the available of currency, the interest rates, inflation. And in that particular case, it was a global financial crisis that literally shut everything down. And then you fast forward to, maybe 2016, 2017, here in our local market, we had a little bit of a bubble. We had a little bubble here in the Canadian market, in the Toronto market in particular. And, the government came in with what they called the 16-point fair housing plan, because housing was getting out of control at that moment in time. People were coming in and buying houses, and values took off. And you can see here that in 2017 is a good example here. If you look at the chart on the right, you see how many months of inventory. It was one of those moments what we had a mini bubble. You can see the numbers. You can start to get a sense of what numbers to track when you're looking for challenging markets, either challenging like we are today, like low, like that's a challenge in low volume, or challenging in high transaction volume, higher than normal, where inventory drops and prices obviously take off like a rocket. And then, of course, they brought in the 16-point fair housing plan. They brought in the mortgage stress test in 2018, and it started to stabilize things back to normal. So we look at this data and these charts, and we think, okay, look, what can we do here to help people understand? And we knew back here inherently that this was not healthy. Like, we knew it. We said to anybody that was buying real estate back then, we said, keep it 10 years. Like, plan to keep your property 10 years, because when things get this tight, it usually means there's going to be a correction at some point in time, or a stabilization at the very least. Of course, we now know, what has happened, and I'm just going to advance here to see what happened to, values in this time period. But if you take here, Ryan, and you draw a line from 2017 to today, there's still about 5% annual increase through the last decade. And that's interesting, right? Real estate, it's gone for a bumpy ride along the way. But if you look at how things behave, 2017, there was a mini bubble. They brought in a 16-point fair housing plan. They brought in the mortgage stress test. It kept values down. It realigned values. And then, of course, in 2020 was when COVID arrived. They dropped interest rates too low for too long. And look what they did. They got out of control. They should have started raising rates back here, at least in 21, that you would think they would have known, like, hey, like, we're coming out of this, where things aren't looking too bad over here. If they had have started raising rates in early 21, we probably would have missed most of this. And sure, we might have had to correct a little along here, but it would have been a much less painful ride for everybody, and it would have just ended up in a much better place. But that's where you can see, of course, when you look at the chart on the right, how fast prices advance. Prices cannot go up sustainably at those levels for a long period of time. It just doesn't work. And then, of course, we now know what's happened. After that, we certainly had to correct. But you can see here, as the chart says, 5.2% annual price appreciation. If you smooth out all these ups and downs, still a pretty good result.
Yeah,
so
that's an important thing to note for sure. I work with a lot of investors, and I invest myself in the real estate market. And, I always say it doesn't really matter what happens tomorrow or next year. I don't care if it goes up or down. I mean, obviously I prefer it to go up, but over the long,
Right.
Yeah, my thesis is buy and hold. It's to build a portfolio to pass it down to the next generation. And that thesis is still very, very positive when you're looking at it over a long period of time. When I started investing, I looked at the historical numbers and I looked at the ups and downs, including the 90s. And I was expecting a 5% compounded growth rate on my portfolio. And I'm like, I don't want to put my money anywhere else other than real estate, because once I lever that, I'm getting a considerably higher return on investment without, major volatility over long periods of time. And, real estate still offers that. You just, if you bought at the peak, you're feeling it. And I bought real estate at the peak as well.
Yes.
So I'm certainly feeling it, but I'm very confident in the next 5 years and 10 years.
Well, that's it. You have to look. Patience is profitable in real estate, and the thing is, we had a 20-year run is the other part of this story, which isn't on these charts. But if you go back to early 2000s, right, and we literally, besides the 2017, blip here where things got a little hot, it was a pretty steady growth period from about 2001, 2002, all the way up to 20. This got crazy. So let's say, from 2001 to 2021, it was a pretty solid growth period. It got out of control after that point, of course, and now we've had to pay for that damage that was created in the markets by free money too low for too long. And so, but if you smooth it all out, you're looking at 6% annual returns. You leverage that, like you said, and you're looking at 15 to 20% returns. Total,
do you think that people should be able to expect that over the next 10, 15, 20 years?
I don't know that answer. I really don't. My gut says that we will see solid returns over the next 10 to 20 years. Is it as good as the previous 20 or the previous 20 before that? You would think it would be, because all those 20-year blocks really pretty much behave the same. We go back to 1980. And the average price appreciation since 1980 to 2025 is about 6.3% through all those highs and lows. 45 years of highs and lows, the average has been 6.3%.
So, and you can even break it down in 10-year increments and still you could see that growth over 10-year periods almost consistently throughout that period.
You can. So, if history is any indication, if you believe that our country is going to continue to grow, Ryan, and you believe that our demand or our need for housing is not going to change, and you also know that our supply is going to tighten up here. I know we're getting sort of to the end of time here, but I want to just stop sharing this. There's lots of data here, lots of charts, and your clients.
And we'll share that with you guys. Just register with us. We'll get it over to you.
Absolutely. So Ryan, here I've got a quick few slides I just wanted to share in conjunction with what we just talked about, because we were talking about do you believe that the country's going to continue to grow, population's going to grow, and then if that's the case, because we were talking about where our value is going to go in the next 5-10 years. Well, this I think is so important to to understand. And this particular slide is something that we talk about and show often now. And you can see here, this is the new condo delivery. So these are units, as you know, Ryan, that are actually being occupied each year and delivered each year. And these are our peak years here, which is 25 and 26, and things are starting to drop quickly. But what I want to talk about is what's happening in 2029 and beyond. As you know very, very well, that new construction product is not selling. And so with that, we're ending up with no new deliveries, because it takes 4 to 5 years to build a condo. But you can't start building, as you know, until you sell them. So we're selling nothing, which means nothing's getting started, which means nothing's going to get delivered in 2029, 30, 31, 32. So if you think about that for a second and say, okay, well, sure, we've got some supply here to eat up, but you think about that as well. Like, we've had our 2 largest years of supply delivery, and condo prices are holding fairly well, right? Unsold inventory is growing a little bit, but really, like, this is average unsold new condo inventory. These are average resale prices. It's not like the line is going straight down and like values have dropped in half. So you think about that. We just absorbed roughly 60,000 new units of new supply in the Greater Toronto area in the last 24 to 30 months. And prices only in a market where we're in an adjustment market, and prices only dropped, $100 a foot, right?
It's remarkable.
So it's remarkable to know that. And so now you fast forward to 2029, 2030, 2031, when there's no new deliveries coming, literally. I mean, it'll be, a few hundred units maybe that were delayed on delivery. So
that's unbelievable as well.
Right? Isn't it wild? So you think about that. So if you try to figure out where, values are going, I take you back to this chart and just say, hey, supply and demand, economics 101. Let's look on the bottom right corner here of what they project to be delivered from our friends at Urbanation in 2029. And then, 2031 basically goes to zero at this point, because these are deliveries. So all this stuff was sold, 4 or 5 years ago and finally built and delivered, but you're not selling anything here. We haven't been selling hardly anything for the last 24 to 30 months in new construction. And so look forward.
And remind me, Chris, is it under construction or is that scheduled?
This is under construction and scheduled to be delivered.
Okay, and the other under construction, because a lot of projects have been canceled as well, and these numbers have shrunk over time.
And will continue to shrink. Last year, there were over 7,000 units canceled.
Yeah. And that was future supply.
Correct. Yeah. That's never coming out of the ground or is delayed until they, restart the projects again and resell them and get them going. So, I just want to wrap up by saying it's tough when you're looking at historical data to say, look, over the last 45 years, prices have gone up 6.7% a year, but they've gone up. Some years they went up 28%, and some years they went down, 10 or 15. But mostly they're in that, low single digit to high double digit, or high single digit to low single digit, range. That's a healthy range that we're looking at. But when you have moments in time like this, you can look ahead and say, okay, if you believe there's going to be more people coming to this region, which I believe, immigration will continue. If you know, like, this is this is irreparable damage to the supply chain, because you can't physically build condos any faster than 4 to 5 years for high rise, right? So there's going to be a blip in time here unless we start selling, not even unless, like, it's an impossibility. 29 and 30, we're almost getting, at this point, it's a done deal. After that, if we start selling some condos now, then we're going to new construction, let's say in the next year or so. Then by 2031, 2032, we might see some new inventory coming in. But so you take the supply out, you increase demand by bringing even a normalized, annual volume for Canada is about 400,000 or 500,000 people a year coming into the country. It's needed. Growth is needed for our country. It's fueled our country. It's been an incredible story for our country, inviting so many great people to be able to, reside here and enjoy this incredible place we call home. And that's going to continue. And so you look at that, Ryan, I think we're looking for, a definite value change here in a positive way. Do we have a bumpy next 12 months or so as we work through this? The condo market might take another 18 to 24 months of bumping along, but ultimately, fast forward 4 or 5 years from now and look out, you're going to wish you had bought a whole bunch of stuff right now. Anyway, that's my perception of it based on my beliefs in terms of where supply and demand are going to go. If you don't think people are going to be moving to this country anymore and immigration is going to go to zero or negative or whatever, and if you feel that there's enough houses out there, then yeah, it'll just be, slower growth for prices for longer. But
there's an interesting stat you sometimes talk about. So comparing today's sales volume or last year's sales volume to the 90s, which is an atrocious low amount of sales for the Toronto Real Estate Board. while simultaneously we have 2 million more people actually in our country, or in our city, I should say.
Yes.
So, what does that mean? Like there's obviously demand. It's just not entering the market right now. So is it piling up on the sidelines? Is that demand going to come back? And, I'll kind of answer this for myself. The way I always see this is the market's obviously made up of buyers and sellers, supply and demand and supply. And we know what's happening here. We can see very black and white numbers, what is going to happen on the supply side. And, if you break down these numbers even further, there's a lot of completions happening outside of Toronto proper, downtown Toronto. So you'll probably start to see downtown Toronto recover a little bit sooner in terms of rental prices. I'm already seeing it happen in the last 2 weeks, which is phenomenal. I think it's the back to work, but I've never seen so much action on my lease listings in February in my life, or my career. But we know what's going to happen on the supply side. I mean, the big question mark is, when do the buyers come back? I mean, interest rates are low again. That's typically a driver. But what else is going to persuade them? It's probably going to be geopolitical, macroeconomic factors. What's your take?
Absolutely. And it is going to be the geopolitical, I think, because the confidence that we need to have, Ryan, in terms of, bringing people back to feeling good about the trade situation we have globally. Is their industry going to be affected, not affected? I mean, every day there's a new headline, and so we need some stability. And I would say right now, values are in a good place, interest rates are in a good place, but consumer confidence is the number one thing right now that I think is holding people back. But we are starting to see that. We're starting to see first-time buyers come back into the market this year. We're starting to see that need for housing. And we have to remember this, and we saw it in the 90s. People can only hold their decision-making for so long. And then they've got to say, hey, life has gone on. I've got to live. We're going to make decisions. Remember, in 2026, we actually had, if you combine the number of lease transactions and sale transactions, so the total, what I would call the total demand for housing through the Toronto Regional Real Estate Board, was the highest it's been in I think, in decades. And it was higher than 2022.
2025, is that what you said?
2025, yeah. So 2025 total combined units leased and sold in the Toronto Real Estate Board was higher than in 2022. So the need for housing hasn't disappeared. It's just that there were more people choosing to rent right now than to buy, while they determine their confidence level and what the future is going to look like.
Right.
And so you're going to see, so from an investor standpoint, there's demand for tenants there. There's no doubt, you just talked about it. And from a buy-sell side, we've just got to get that confidence back. So all those people that are, or good portion of people that are choosing to rent will eventually choose to buy. So that ratio of sales to leases will switch back over to the other direction.
Yeah, and I think most people will wait. It's a herd mentality. They're going to wait until prices start going up, and then they'll jump in. And many people jump in when prices are, going up at the halfway, and then most will jump in right at the top. It's always the case. But yeah, I'll kind of leave like an open-ended question to the audience. If you know that there are more buyers than there were, in previous years. There's less supply coming, historical low supply. It's pretty telling to me where prices are going to go. And, I think a lot of it will happen when that really low supply starts. The cycle starts in the later half of this year, probably already started, but we'll really start noticing, I believe, next year. And then that's when buyers will most likely start reacting, just locally. They'll see that, supply is lower, prices are starting to go up, and then you'll start seeing people move off the sidelines in a meaningful way.
100%. And that's what we need to see. And we will. It's just, like you said earlier, do you think values are going to go up? What do you think the next 5, 10, 20 years are going to look like? We live in one of the greatest places on earth, right? We know that. We're one of the most attractive places in the world to live for lots of reasons. Do we get it perfect here in Canada? No, we don't. But hey, on a global scale, we're a pretty good spot. And so if you believe that that's going to attract people over time, and you know that we don't have enough housing in place to really meet that demand, and we're about to hit a real lull in supply, then I'd say, you know, you can count on prices going up in the future, and probably back. I hope. I look. I'm happy with mid-single digits every year for the rest of our lives. Hey, that'd be great. The up and down is the stuff that kills you.
Yeah, that's right. Awesome. All right, Chris, I appreciate your time as always, and really appreciate your insight. Thank you for everything you do for me, my team, and the brokerage. And you guys just message us down below, comment. We'll send you the report. And it was great seeing you.
Great to see you as well. Thanks, Ryan. We'll talk to you soon. Have a great day.